is going to go on. Okay, guys, John Oliver here. You all know me. I'm a Master Club Award winner. I've been winning that award every week for over a year, every week for over 52 weeks. That means I'm verified as a trader who makes at least a 70% gain every week on my trade. So that's my expertise for what it is. And I'll show you the kind of things that I learn. And it's one of those things you want to be constantly learning, getting on these calls, getting on the go lives. The go lives are the best thing to go on with Brandon Boyd and Josh Lee. Some of the other educators also do Impulse. Brandon Boyd and Josh Lee are on 3 times a day, Monday to Friday. The only disadvantage with the go lives is they don't necessarily take questions there in the go live. You can go onto their Go Social page and ask questions there, and they are responsive there, but obviously they're off the charts by then. So these live sessions, I'm not calling out trades per se, but I'm showing you what a trade setup would look like. And if you decide to take that trade, that's up to you. But a lot of it is the skills that you can take moving forward so you can trade yourself, because that's the whole idea. So I'm going to share my screen right now. And let me get to the impulse strategy right here. As many of you recognize this strategy. I'm going to show you.
John, it's on wikifx.com.
It is? Okay.
Yeah, it's on the wrong screen.
Okay, hold on then. Let me do that again.
Okay.
There we go. Thank you for that, Tony. Appreciate that.
Yep, perfect.
All right. So this is our screen. This is what we're going to be looking at while we move forward with this. But what I am going to do before we start that, I did have some questions earlier about how we mark up imbalances, and typically I do that specifically on gold. So if any of you are trading gold, I'm going to switch to Aurus to show you, just because it's a cleaner chart to show it on than Impulse. But if you do it on Impulse, what I suggest you do is you go up here and you hide the arrow so it makes it clearer, and then it's much easier to see the imbalances on here. But for now, what I'll do, I'll just, for clarity, I'm going to show you on Aurus. And so what we look at, I usually put my imbalances because I'm a scalper and I scalp on the 1 minute time frame. I'm going to look at my imbalances on the 5 minute or the 15 minute. I only want to go 1 or 2 time frames higher than the time frame I'm trading on. So if you're trading on the 5 minute, for instance, you want to put your imbalances on the 15 minute or the 30 minute. If you're trading on the 1 hour, you want to be looking at the 4 hour or the daily to put your imbalances in there. And basically what an imbalance is we look at a candle like this one here, as a for instance, and we see that the top of the candle before it and the bottom of the candle after it do not match. There's a gap. And so that gap, I'll show you here to clarify that gap from the top of this candle to the bottom of that candle, counting the wicks, that gap there is what we call an imbalance. What that means is, in technical terms, is the buyer orders and the seller orders are not matching. And so typically on a lot of trades, the candles are going to overlap and there's no gap. But on some trades, and in this case, there's a few of them, there's imbalances. So what that means is the market hates an imbalance and it wants to come and fill that space up. And so you can see an imbalance here. And what I do is I stretch that out this way. I'll just stretch it that far. There's another imbalance here. So there can be several imbalances. So this candle here, we see there's an imbalance from the top of that candle to the bottom of that candle. The color of the candle either side of your subject candle does not matter. It can be green and green. It can be green and red. It can be red and red. So the color of the candle does not matter. What matters is either side of your subject candle, there's a gap. And so you go over to this. What I like to use is go over to this. It usually shows when it's in its normal stage, it's the brush. And if you click to the little arrow on the right hand of the brush, you'll see it says geometric shapes. And when you click on that, you go down to rectangle and you can click on that. And so what I do is I go from the top of that candle over my subject candle to the bottom of that candle, and then I stretch it out to the right. And so what happens in this case, the price action was going up. It created a gap here, which has got to be filled. It carried on going up. It created another gap here, which has got to be filled. It came up to this candle, and you see there's no gap. The top of that is higher than the bottom of that. So there's no gap in between that. Then we get to this candle, and what we're anticipating, the reason we're looking at these imbalances is because if we know the market's going to come back to those levels, so what it does is it's going up and up and up and up here, but it's going to come back and go through these levels here. And so what happens is right here, it goes out and it takes out that imbalance. So when it takes out that imbalance, that rectangle there, that one there is no longer valid. So the imbalance has been filled. We can get rid of that imbalance. Then it carries on down here and it takes out this balance, goes through there. So that imbalance is taken out. So that now is invalid, okay? But now you can see on the way down, we've created another imbalance around this candle. We've created a small imbalance around this candle, and there's no imbalance around this candle. So again, there's a gap. This is our subject candle. The candle immediately in front of it ended here. And if this candle came up to it or went higher, there would be no gap, but it didn't. It only made it that high. So again, we go to where our brush is, click on the arrow, go to the rectangle, and we draw it from the bottom of that wick to the top of that wick, and that is our imbalance area. We'll drag that to the right so that we can see it later on. Then we come down here, there's another small imbalance. Wick was here. This is our subject candle, and the other wick didn't come up to match that one. So there's another imbalance here from the bottom of that candle from the bottom of that wick to the top of that wick. There's another imbalance there. And as you can see, price went down and down and down. It bounced off. You can see this level has got quite a lot of support there. So you're anticipating it bouncing around here anyway. And it does go up, and it took out this imbalance here. So it went straight through that imbalance, so we can get rid of that. It went straight through that imbalance, so we can get through that. But you notice that that trade there took out two imbalances. Those trades there took out two imbalances. So you would have made money on the way down, and you would have made money on the way up. Now, that's in a very short time frame. Doesn't always happen like that. And I'll demonstrate it now, because here, what have we got here? We've got a candle here that has an imbalance in it. The wick here is lower than that wick there. So you can see that, right? So what we're going to do, we're going to put a rectangle from the top of that wick to the bottom of that wick, and we spread it out to the right, okay? Nothing's hitting there, right? I'll show you what we do. there's another imbalance on this candle. Can you see that? Starts here, and there's a gap between that and that. So we would put our rectangle again from the top of that wick to the bottom of that wick. But when we spread it right, we can see immediately, a couple of candles later, this takes out the imbalance. Soon as a wick goes through it, and to be honest with you, it only has to go halfway through it. So on these imbalances, what I always target is the halfway line, not the full line. All the examples I showed you actually took them out fully. Doesn't always happen like that. If it does, great, you'll catch more pips. But you want to be aware that it only has to go through 50%, which is right down the middle here. But this imbalance here got taken out just 2 candles later. So this is now invalid. Once the imbalance has been taken out, it's invalid. Take it off your screen. But look at this imbalance here. Can everyone see that? There's nothing comes down to it. So we got to keep going. So we're going to keep going here. And you think, oh my God, you know, nothing is I'm going to clear some of that off so that we can see the whole page here. Nothing is hitting. So what we do is we're going to keep dragging this to the right because it's still valid. Even though nothing's hit, it's still valid. And don't forget, this started at 7:45 yesterday in the morning. Okay, so this is for all your swing traders, intraday traders, and position traders. But even as scalpers, Tony and I are scalpers, we will keep this on our charts because we know there's a very good chance that we're going to hit that at some stage or another. We're still going. Now we're now in today. You look at the bottom of the screen, 11th of September at 2:30. Still hasn't hit. Still hasn't hit. Whoa, guess what happened? Bang. That imbalance was taken out. So if you knew for an absolute certainty that this imbalance was going to be taken out sooner or later, and you're going to have guaranteed win on that, you know that this is going to pull it down to this level. That is why imbalances are so important, because the market has to fill those imbalances sooner or later. Sometimes it's done in 1 or 2 candles. Sometimes it can be 10 candles. In this case, it's, you know, it was started at 7:45 and it's 5:30. Nearly took a whole day. Took about 22 hours for that imbalance to fill in. Again, once it's filled in, we do not need it anymore. So we are going to take it off. Okay, so that's how imbalances work. I'll go back to impulse now. If anyone has any questions on that before I change that, speak up now so I can answer you. If not, we're going to go on to the PSARs next. If you think of anything after this, you know, you can ask it at the end of the session. If you don't have any questions now, I'm going to switch to showing you how to set up the PSARs for your entry and exits. Okay. Let's go back to impulse over here. Everyone can see this screen. I'm going to take the candles off here. You know the basics of impulse. When you're in buys, you're looking for everything blue. You're looking for blue arrows up here. You're looking for your RSI to be in blue over here. You're looking for this to cross up through the blue on the stochastic. And you're looking for other things, the blue crossing the red, obviously. For a buy, you want the trend line to be blue. For a sell, you want the trend line to be red. So when we're looking at buys, we're looking at everything blue. When we're looking at sells, we're looking at everything red. But to show you how the PSARs are set up, I'm just going to take the arrows off, which you can do with this indicator. You just press it and it comes off, just to show you how to set up the PSARs. Now, the PSARs stand for, and I'll show you this, when you go up to this FX area here at the top of the screen, and it'll show you when you mouse over it, it'll say indicators and strategies. When you click on that, you'll get a box open. I have parabolic PSAR already starred, so it's already at the top. But yours won't be starred the first time. So what you need to, when you start typing parabolic, it will come up. When it does come up, I suggest you star it if you like this, and it will always be at the top. Okay. So then you click on it. And what will happen then is the PSARs will appear on your screen. Now, what happens when they appear? See these little dots up here? That is the PSAR, parabolic, stop, and reverse. They're a little bit small and you can't see them. So what I'll do is I'll hover over it until I get the hand signal. I will right click on it. First of all, I'm going to do visual order and bring it to the front so I can see it at all times. Then I'm going to right click on it again and I'm going to settings and I'm going to change the blue to a black so that I can see it. And I'm going to change the thickness from the smallest, this is the second smallest. Have a look over here, what they look like now. This is the smallest level. Have a look when I click it on here. See how big they go? That's so you can clearly see them. Okay? And so what happens with a parabolic stop and reverse, there's a lot of calculations go into these, what we call PSARs for short. And it's a very complicated equation. You don't need to know that because they just appear normally on your charts. They're already set up. Don't have to do anything. If you want this to appear each time that they come up, you can save this as a layout and just mark it PSAR. And then every time you want it to appear, you just load that layout and it will come. The reason why it's very important is because it will, working in conjunction with the other indicators. So don't forget, we still want to be looking at blues for buys down here, etc., etc. But what we're looking at is this will show you in the name parabolic stop and reverse. So when they're going up like this and they're underneath the candles, we're in buy mode. And when you look down here, you can see we're clearly in buy mode because our line, our RSI line, is in the blue area or above. So we're clearly in blue. Our main trend line is blue. Our blue secondary trend line, EMA, is above the red EMA. So you know you're looking for buys. When the PSARs are below, you'll know you're looking for buys. So what happened here? We were going up and up and up here. We suddenly had a reversal. It stopped and reversed here and here. Then it stopped and reversed and jumped down here. This would be an entry. So if you were in a buy coming up here and it suddenly stopped and reversed, you could get out there. It actually turned around very quickly, stopped and reversed again. So this would be another entry to get in here. And you can run this all the way up, all the way up, all the way up to here until you got the stop and reverse again and you could get out. And as you can see, it just touched the red. It actually didn't go through it, but we don't know at that time. And off it went. Okay, so that's a good way, gives you an extra indicator when it's going from buy mode to sell mode. Or if you're in buy mode and you don't want to go for a sell against trend, because it's still blue here, so any sells are against trend. We don't really want you to take sells against trend. Then when you're in a buy, you would just use this reason for getting out. You would be out on all of these because they're all sells, and you might get in over here. There's some other reasons why you wouldn't get in there. So that's why you can't rely just on this as an indicator. Okay? And that's a parabolic stop and reverse. Here is a perfect example of how you would use it to get in or to give you another indication for getting in a trade. So you can see here, obviously, we got a blue trend line. We're in a buy. This is gold, by the way. So we're in a blue trend line. We're looking for buys. So there's a crossover here. We got the blue crossed over the red here. We're in the blue down here. So we could have got in for a buy right here for a number of reasons. And the PSAR flipped. So you can see we were in, the PSARs were above here. As soon as they flipped, we're looking to get in for a buy. We're in the blue trend, we're looking for a buy. The blue cross red, we're looking for a buy. The blue candle went up into the gray area, we're looking at a buy. The blue jumped up into the blue area, we're looking for a buy. This area, oops, sorry, let me get rid of that line. Let's do it over here. This area here would have given you the heads up when it crossed here that this was getting set up for a buy. We're looking for a buy. So you got a heads up there. We're not in because these PSARs are above. We're waiting for them to switch. They switch right here. So we're in right here. Okay. And then the PSARs show us all the way up, all the way, all the way, all the way that we're in a buy. When the PSARs flip like that, we know that's another indicator to say we're getting out. And right here, you can see as well, right here, it's an indicator to get out. We went from the blue across into the red. It was actually on that candle, so we would have got out. So we would have made pips from here all the way up to probably about here. And then we would have got out, okay? Then we've got sell PSARs up here. We're in the red down here. But guess what? We've got another indicator right here. Blue cross is back across the red and is heading up. We got a PSAR right here, which is right here. And we've got a candle right here indicating that we're going up. The candle went above the blue line into the gray, and we crossed into the blue line here. Oh, that didn't take. We crossed into the blue line here. So again, we're in this buy here. The PSARs are underneath all the way, all the way, all the way up to here. So we would have stayed in that trade all the way up to here. So from there to there is where your pips would have been taken. We could have got out there. Look, it didn't go into red, but it looked like it was going to. So you probably would have got out there. But this candle was an engulfing candle. It did go into the white area. It went through the blue line and the red line. So that would have been your exit all day long. Okay. Now, why is the PSAR important for setting your stop loss? Here's the reason. If you set a stop loss at a certain amount of pips, like 10 pips, 20 pips, 50 pips, 100 pips, whatever you're trading, obviously gold, you need to set your pips a bit longer, a bit wider, same as on US 30. Otherwise, you're always going to be stopped out. But what I do is instead of calculating where the stop is, if I enter on this candle here, my stop loss is where this PSAR is here. Simple as that. As it moves up into profit, I can move my stop loss onto another PSAR here when it's up here. And don't forget, if you were in here, right here, and you move your stop loss here, you're already in that much profit and you've guaranteed a profit on your trade, even if it turns around. This is called a trailing stop loss, where you keep moving your stop loss up as the PSARs go up, and you're locking in more and more profit as it goes up. When it went to here, even though this candle here, let me just make this a bit bigger so you can see it. Well, this candle here just about came and might have taken your stop loss out, but you would have made all that money all the way up, and it's guaranteed money because here was break even. So you more profit, more profit, more profit, more profit, more profit. What it means is you don't have to get out these trades. So when you start seeing red candles and you get a bit nervous, you can stay in the trade, which means you can run your trade all the way up from your entry here to your exit right there and take all those pips without getting out. Okay. So does anyone have any questions about that? I'll put my I'll put my candles back on there. I'm going to stop sharing my screen for a minute and come back to you guys. Okay, so I'm going to stop the recording right now. We're going to take questions if there are any.